What if I told you that the US Federal Reserve, the stock market, and even the immigration policy are all colliding right now to shape the future of our economy? Well, it's US economy, but it is also the global economy. And the decisions being made today could determine whether we enter a new era of growth or another round of sticky inflation. Let's break this down in plain and simple English. Let's go. Let's talk about the Fed's dilemma. So the Federal Reserve just cut rates by 25 basis points this week. Sounds small, right? But here is the twist. Some members within the Federal Reserve wanted bigger cuts, while others wanted no cut at all. That tells us there is a deep division inside the Fed themselves. Now, here's why this matters. On one side, you have people like Jim Bianco warning that the Federal Reserve might actually be reigniting inflation. Remember, payroll growth looks weak on paper, just 22,000 jobs in August. But here is a catch. The US population growth has slowed dramatically. Less immigration, more deportations, and border tightening. So maybe we don't need hundreds of thousands of new jobs each month. Cutting rates into this environment could fuel inflation. Makes sense, right? On the other side, you have Tom Lee, who is one of the bullish guys I've ever seen, saying, relax guys, this is exactly the green light corporations need. He thinks we are on the edge of growth without inflation, driven by AI, blockchain, and productivity gains. In other words, more output without higher prices. So two smart people, two very different outlooks. Who's right? We'll get to that. Let's talk about sticky inflation, tariffs, and AI. Jim Bianco makes another critical point. Tariffs. When Trump slapped new tariffs earlier this year, people thought inflation would spike instantly. It didn't, because companies had pre-tariff inventory sitting in the warehouses. But by the spring and summer of next year, that inventory will be gone, probably, and the prices are likely to creep higher. At the same time, AI is like the internet in the late 90s. Not a huge revenue driver today, but in the next 5 to 10 years, it could completely reshape GDP growth. Think of it as planting seeds now that we won't harvest until 2030s. So the Fed is stuck. Do they cut to support today's sluggish growth, or do they hold because tomorrow's inflation could come rolling back? Now let's add another wrinkle. The H-1B visa fees. President Trump just announced higher H-1B visa fees for foreign tech workers. This is huge because Silicon Valley runs on global talent. Companies like Google, Amazon, and hundreds of startups rely on engineers from India, China, and elsewhere. By raising fees, Trump is making it harder and more expensive for US companies to hire globally. So what does that mean? Labor shortages in technology, higher wage inflation for domestic workers, and ironically, potentially slower innovation in the very sector, AI, that's supposed to boost productivity. So on one side, Fed is trying to lower borrowing costs to stimulate growth, but on the other side, immigration policy is raising costs for the very companies leading the next wave of economic expansion. So what does this mean for investors? Let's zoom out. Here's the reality. The US is in a sticky inflation world, probably around 3%. So forget about that 2% old target. Those days are gone. The stock market is still at record highs, even though sentiment is negative. That's unusual. Historically, markets don't top when everyone is bearish. They top when everyone is euphoric. Productivity gains from AI are real. They take time. Don't expect overnight miracles. So for investors in Canada and across the Western world, here is what this means for you. Stay diversified. Don't just bet on one outcome, like the Fed cuts and stocks moon, or inflation comes back and everything crashes. Expect volatility. With policy pulling in opposite directions, markets will swing hard. And focus on quality assets. High-value growth stocks particularly are the ones going to take advantage of this AI boom. Broad market ETFs if you want to be very passive, and exposure to gold, Ethereum, and Bitcoin to hedge against any potential downside. By the way, if all of this feels overwhelming, don't worry. This is exactly why I offer one-to-one consulting calls. Together, we will map out your personal investment strategy so you are not just reacting to headlines, but actually building wealth in structured long-term way. If you're serious about navigating this environment, check the link below and book a one-to-one session with me. So here's the big picture. The Federal Reserve is divided. Inflation is sticky. Tariffs are pushing prices up. Immigration policies are tightening the tax talent pipeline. And yet, the stock market keeps marching higher. Any news is good news for stock market, fueled by liquidity and cautious positioning. This isn't a simple bull or bear call. It's a tug of war between inflationary pressures and productivity gains. The key for you as an investor is to understand that the rules are changing. What worked in the last decade might not work in this one. So let me leave you with this. Are we entering a new era of growth powered by AI and easier money? Or are we sowing the seeds of the next inflationary spiral? Drop your thoughts in the comment section. I would love to hear your take. And if you like this video, give me a thumbs up, subscribe to the channel, and I'll see you in my next video. Take care.